I'm going to lecture on current cost accounting and the PowerPoint presentation and the problems. Now let's have current cost accounting. This is the last chapter of our textbook. So current cost accounting is a method of measuring assets, liabilities, income, and expenses at current cost at the end of the reporting period. Now, current replacement cost is the estimated cost to acquire similar asset at current purchase price. The essence of current cost accounting is the recognition of holding gain or holding loss. If the replacement cost is higher than the historical cost, the difference is a holding gain. But if the replacement cost is lower than historical cost, the difference is a holding loss. So we have now your preparation or we have realized holding gain or loss is the difference between the current cost and the historical cost of assets sold or used during the year. Unrealized holding gain or loss is the difference between the current cost and the historical cost of the assets still on hand or unsold at the end of the period. Preparation of current cost income statement sales are made at current selling prices throughout the period and therefore not restated. Cost of goods sold in current cost accounting, cost of goods sold equals the current cost of the unit sold at the same sale. Operating expenses are measured at current cost when incurred. These are already stated on a current cost basis. Depreciation is based on average current cost of the property, plant, and equipment. Income tax is already on a current cost basis, but the income tax is computed on the basis of the income under historical cost. So we have now four current cost statement of we have now your financial position, cash and receivables. These are already reported on a current cost basis in conventional statements and are therefore not restated. Inventory is stated at current cost at the end of the reporting period. Property, plant, and equipment. Land is stated at current cost at the end of the reporting period. Depreciable property, plant, and equipment are shown at current cost minus accumulated depreciation based on current cost at year end. Then we have your take note of the difference between land and the depreciable fixed assets. So we have now the payables are conventionally reported on a current basis and therefore do not require restatement. Share capital and share premium, these are not restated. Retained earnings. The balance of retained earnings is obtained from the current cost statement of retained earnings. Current cost retained earnings on January 1, then we add current cost net income, then we deduct dividends declared or paid, current cost retained earnings on December 31. Okay, so these are the very important items that we need to study. Now let's go to the problems at the back of the book. We are going to start with the straight problem, that's 23-12. The only straight problem in the chapter, and then 23-13 is the multiple choice theory. So let's begin with 23-12. The requirement is an income statement and the statement of financial position in accordance with current cost accounting. The Gaspi Company was formed on January 1, 2020. The entity reported the following financial statements pertaining to the first year of operations. So we have now your income statements with net income of 650,000. Then the assets, liabilities, and stockholders' equity totaling 3.7 million. Current cost information on December 31, 2020. Cost of goods sold at average current cost is 3.5 million, but you are given 3.2 million in the conventional current or income statement, but at average current cost 3.5 million. Inventory at average at current cost is 1 million, that's the inventory, and in lieu of 900,000 in the income statement. Then land is 1.5 million, so only 800,000 in the listings of the assets. Then equipment, 1.6 million. We have the depreciated cost of 900,000. Now the income statement, following the guidelines that we have just learned in the PowerPoint presentation. Now we have the amount of sales equal to 5 million. Then cost of goods sold at current cost, given at average current cost 3.5 million. So we have the gross income of 1.5 million. Other income, we have the realized holding gain of 300,000 plus 30,000. So we have 330,000. Now the realized holding gain, and then we have the unrealized holding gain of totaling 1,340,000. Total income, we deduct the expenses of 700,000, and depreciation is 130,000. So we have now the income before income tax, and we deduct the income tax of 350,000. We have now the net income of 1,990,000. Then we have the liabilities and the stockholders' equity for the current assets. We have cash of 500,000. Then we have accounts receivable 600,000. Inventory at the average or at the current cost of 1 million. And we have now the total current assets of 2.1 million. The non-current assets of 1.5 million, the equipment of 1.6 million minus the accumulated depreciation at 10%. So we have the net book value of the equipment of 1,440,000. Total assets of 5,040,000 in lieu of 3.7 million in the statement of financial position. Then we have for the current liabilities, accounts payable of 500,000, notes payable 400,000, income tax payable is 350,000, total of current liabilities. Shareholders' equity, we have share capital at a given amount of 2 million. That's in the statement of financial position. Then retained earnings of 1,990,000 based on the current income statement, and we deduct the amount of dividends given at 200,000, which is already at current cost. So we have the total liabilities and shareholders equity of 5,040,000. Now for the supporting computations, we have now the cost of goods sold, the average current cost of 3.5 million, historical is 3.2. So the current is higher than the historical cost. Now this is cost of goods sold. So we have now a holding gain equal to 300,000. For the inventory, the current cost of 1 million. Then we have the historical of 900. Again, we have unrealized holding gain. It's unrealized because the inventory is still unsold. Cost of goods sold is already realized ang holding gain because we have already the goods sold. Now for land, we have the holding gain of 700,000, but we have now the item as unrealized because the land is still unsold. Then depreciation on average current cost, we have 1 million. That's your equipment, and we have now the amount of 1.6 million divided by 2. So the average now is 1.3 million, and we divide that by 10. So we have the depreciation on average current cost of 130,000 on historical cost is 100,000. So we have a realized holding gain in the amount of 30,000. Now it's realized because this is already on depreciation expense. Now net current cost of 1.6 million, accumulated depreciation of 160,000. So we have 1,440,000, while the carrying amount on historical cost is 900,000. We have unrealized holding gain of 540,000. So you add the realized holding gain of 300,000. Then we have 30,000, 330,000. You have your total of numbers 1 and number 4. For the unrealized, we have 100,000 and 700,000. That's 800,000 plus 540, so 1,340,000 for the unrealized holding gain. So we now get the amounts of realized holding gain 330 and unrealized of 1,340,000. So now we have the a statement of financial position. Now in 23-13, we have the answers to the multiple choice theory. We go to the multiple choice problems beginning with number 1 up to number 11. So for 23, that's 1. We have the question here is 23 dash 1. Now, what are the questions considering that we have 4 items for what's the unrealized holding gain to be reported, the unrealized holding gain to be reported in 2021, the realized holding gain to be reported in 2022, and what's the gain on the sale of land to be reported in 2022. So in 23, In number one, we have the unrealized holding gain equal to 100,000. Now, the company reported the following relation to land. Purchased land on January 1, 2020 for 500,000 cash. December 31, 2020, the land is the current replacement cost of 600,000. So we have in 2020, the unrealized holding gain is 100,000 because the land is still unsold. On December 31, 2021, the land has a current replacement cost equal to 750,000. So historical cost is 500,000, but the current cost on December 31, 2021 of 750,000. Then we have the cumulative unrealized gain in 2021 equal to 250,000. We deduct the amount recognized as unrealized holding gain in 2020 of 100,000. So the unrealized holding gain in 2021 year end is 150,000. The land was sold on December 31, 2022. On this date, the current replacement cost of the land is 800,000. So what is the realized holding gain to be reported in 2022? So for the current cost equal to 800,000, the historical cost is 500,000. So we have realized holding gain in 2022 of 300,000. We deduct the unrealized holding gains reported in 2020 was 100,000. In 2021 was 150,000. So we have now the total reported unrealized holding gains of 250,000. So the realized holding gain to be reported in 2022 is 50,000. Now the gain on sale of the land with sales price of 1 million and the current cost of 800,000, the gain on the sale of the land is 200,000. The income statement would show the following among other income: realized holding gain of 50,000, then gain on sale of land of 200,000. The actual gain from the sale of the land is 500,000. That's 1 million minus the original cost of 500,000. Only the net amount of 250,000 is reported in 2022 because the balance was already reported in 2020 for 100,000 and 2021 150,000. So in 2022, we have to report the amount of other income of 250,000. Then we go to 23-2. What amount of depreciation should be reported in the historical cost income statement for 2020? So the historical cost is 5 million on the equipment acquired in January 1, 2020. Depreciation is computed using straight line method. The useful life of the equipment is 5 years with no residual value. So we divide 5 million historical cost by 5 is equal to 1 million. That's letter A. Number two, what amount of depreciation should be reported in the current cost income statement for 2020? Now, if we have the current cost of 5 million and we multiply it by 225, that's the price index on December 31, 2020, and it's 150 on January 1, 2020. So the average is 225. That's at the end and at the beginning of 150. So the current cost is 7.5 million. The average current cost is 5 million, the original cost, and 7.5 million, that's the current cost. So we divide it, the total, by 2, we get the current cost average of 6,250,000. Then the depreciation on average current cost is 6,250,000 divided by 8. Uh, the question is, what amount of depreciation should be reported in the current cost income statement? So we have now the depreciation to be computed using the straight line method. Using the straight line method, so we have the estimated useful life of the equipment is 5 years with no residual value. Now that was the initial life of the asset with no residual value. Okay, so at this time you have to consider that there is no residual value, so we have to deduct 0 from that amount. Okay, so why do we have the amount of 8 years of dividing now the depreciation on average current cost? That's supposed to be 5, not 8. 6,250,000 divided by 5. So will you make correction? 6,250,000 divided by 5 is 1,250,000. That's letter B, 1,250,000. Now please make correction. 6,250, that's the average current cost divided by 5. That's the depreciation based on current cost for 2020. Now, what is the realized holding gain on the equipment to be reported in 2020? Depreciation on average current cost 1,250, depreciation on historical cost 1 million. So we have the realized holding gain equal to 250,000. What is the unrealized holding gain on the equipment to be reported in 2020? We have the current cost of 7.5 million, the accumulated depreciation thereon computed divided by 5 is 1.5 million. So we have the net current cost of 6 million. Based on historical cost, we have 5 million minus the depreciation based on historical cost 1 million, so we have only 4 million. Net current cost 6 million and the carrying amount of 4 million. The unrealized holding gain is 2 million. The asset is still unsold and we have the depreciation to be recognized in the next years. Now, question in number 23, what amount of depreciation should be reported in the historical cost income statement for 2020? The company purchased a machine for 1,150,000 on January 1, 2020, the first day of operation. The current cost of the machine was 1,250,000 on December 31, 2020. It has no residual value, has a 5-year life, and is depreciated by using the straight line method. So we have now the depreciation on historical cost is taken by dividing the historical cost by 5. Then the amount of depreciation that should be reported in the current cost income statement for 2020 is equal to we have the historical cost January 1, 1,150,000. The current cost on December 31, 1,250,000. We have a total of 2,000,000 400,000, and we divide this by 2, we get the average current cost of 1.2 million. So the depreciation on the average current cost is 240,000. That's letter C. The realized holding gain on the equipment for 2020 is taken by comparing the depreciation on average current cost and on historical cost. We have the realized holding gain of 10,000. It's already realized because depreciation is already expensed. Now, in question number 4, what is the unrealized holding gain on the equipment for 2020? So we have the historical cost, 1,150,000. We deduct the accumulated depreciation for 1 year in the amount of 230,000. So we have the carrying amount of 920,000. The current cost of 1,250,000. Then the accumulated depreciation on current cost is 250,000. So the net current cost is 1 million minus the carrying amount using the historical cost of 920,000. So we have the unrealized holding gain of 80,000. Next, for 23-4, in the statement of financial position restated to current cost, what is the net current cost of the property, plant, and equipment? What is the net current cost of the property, plant, and equipment? Okay, so we have the amount of in 2018, 1,400,000 multiplied by 70 percent, and that's with the depreciation already considered, 980,000. Then 2019 is 380,000 multiplied by 80%, and in 2020 we have 440,000 multiplied by 90%. So we have 396,000 for the uh, current cost, the net current cost of the property, plant, and equipment. Now, for number 5, the company owned the following two assets at year end. So we have the current cost of the equipment and the inventory and the recoverable amount. The entity voluntarily disclosed information about current cost at year end. 5 minutes. Oh, okay. So we have now in such a disclosure, what total amount should be reported for the equipment and the inventory. In this case, we have the equipment with the recoverable amount of 95,000 and the inventory with recoverable amount. The entity voluntarily disclosed information about current cost at year end. So we have now for the equipment, the recoverable amount is only 95,000, but for the inventory, it's only 80,000 according to AI CPA as fast number 89. requires that current costs for inventories and equipment shall be measured at the lower of current cost or recoverable amounts. No, this is already and is past number 89. So that's why we have the lower of equipment, it's 95,000. For inventory, it's 80,000. Next, in problem number 6, question number 1, in the statement of financial position restated to current cost, what's the inventory on December 31? Now we have the amount of 1,080,000, that's at current cost. So we have 15,000 units, and then multiply it by 72, the year end current cost. Then we have question number 2. What is the unrealized holding gain on inventory for the current year? The unrealized holding gain on inventory in unrealized because the inventory at year end is still unsold. So the inventory at current cost 1,080,000. The given amount of historical cost is 945,000. The amount of 135,000 is still unrealized. Then in question number 3, in the income statement, it's stated to current cost, what is the cost of goods sold for the current year? So we have now in question number 3, cost of goods sold at average current cost. We are now given 40,000 units, and then we multiply this 40,000 units by 65, and 65 is the average, adding 72 and 58, that makes 130, divided by 2 is 65 per unit, so you get 2.6 million. Then the historical cost of 2,375,000. We have now the result, no, of 225,000. That's considered realized because the goods were already sold. So we have in number 4, 225,000. Next, in number 7, uh, what is the inventory on December 31 at current cost? So we have now in question 1, the inventory on December 31 at current cost is 9,000 units. That's your number of units purchased for the inventory units. So we have inventory in December 31 is 9,000 units, and then we multiply it by 71. If you are going to add here, you have beginning inventory of 8,000 units, then you add 7,000. That makes 15,000 plus 15,000, 30,000, total of 39,000. That's your beginning inventory and purchases. But for the units sold, um, we have 7,500 plus 7,300 plus 8,200 plus 7,000. So we have now total of 30,000 units. So beginning inventory, add purchase 39,000 units minus the units sold of 30,000 units. We have the ending inventory of 9,000 units. And then we multiply this by 71. That's the inventory at current cost. What is the unrealized gain in inventory for the current year? So if you have now the inventory on December 31, 2017 at current cost of 639,000 in question number 1, and then the cost is 630,000. We have an unrealized gain equal to 9,000. Okay, in question number 3, in the income statement is stated to current cost what is the cost of goods sold for the current year. So we have now the cost of goods sold for the current year, 30,000 units sold. Then we multiply it by 64. If we add 71 and 57, so the total divided by 2, that gives us 64. And then we multiply it by number of units sold. We get 1,920,000. In question number 4, the average current cost, 1,920,000. Then the historical cost of 7,875. That's the historical cost of the units sold. We now get 135,000. That's your realized holding gain because the inventories were already sold. Now, how did we arrive at the historical cost 5 of 1,785,000? Of course, we have to use the number of units, 8,000 units in the beginning inventory. We multiply it by, or the total cost of 400